Advanced Financial Accounting Excel Practice Problem. In this presentation, we will work a practice problem in Excel related to pushdown accounting. In other words, we have a parent-subsidiary relationship. We're going to be applying pushdown accounting in this scenario. Get ready to account with Advanced Financial Accounting. Here we are in our Excel worksheet. We got the information to the left. We're going to be entering that into the blue area on the right. Note this will be a comprehensive problem, so we're going to have a couple different areas that we will be populating as well as down below. So we will be doing a bit of navigation within this problem as we work through it. Let's take a look at the text here. We got P acquired all of S. We have a parent-subsidiary relationship. P, parent company, S, subsidiary, common stock on January 2000 X5. The amount $4,942. So then the fair value and book value are the same, we're saying, except for items below having fair values of the $65,000. So what we're going to do here is I'm going to list the actual balance sheet or the trial balance for S, the company that was purchased here. And we're saying, hey, look, all the accounts, the fair value and the book value were the same except for these items. So in other words, when we're thinking about this purchase price, we're thinking, okay, what do we typically do? We will take a look at the book value, assets minus liabilities. This is at the point of purchase, we're going to say, and that's going to give us the 689, which of course will also equal the equity here. However, these items, some of these items we need to revalue. So we're going to revalue some of these items at the point of purchase to this numbers over here. All right, so then, and to consider and compare that to basically the purchase price. Then the remaining useful life is going to be 19 years for the building and 9 years for the equipment. And then we're going to be using pushdown accounting for S's books. So what's going to happen here? P purchased S, and now we're going to say instead of us basically doing the adjustment to fair value at the point in time we do the consolidation, we're going to say, hey, look, we're concerned about the consolidated financial statements being as easy to prepare as possible. So what we would like to do is revalue S's books here, because note what happened. P purchased this stock of S. So that means nothing, this trial balance for S typically wouldn't change then at that point in time. Only ownership has changed. However, due to us wanting to make the consolidation easier and due to the fact that there has actually been an exchange that took place, so there is some kind of justification for us revaluing at this time, we're going to say, hey, look, we want to revalue S's accounts that account for, the sales price. It's tie out basically to the sales price. So we're going to revalue these accounts for S. All right, and so we said here that these are going to be the values that we believe the accounts are worth, and we're actually going to adjust S's books to the fair value at the point in time that the purchase took place. So let's consider, that transaction. So we would say, all right, all I'm going to do is I'm just going to say, well, this is the inventory that was on S's books, and now we're saying that it should be the $65,000. So I'm going to say that we need to increase it by $65,000 minus the $59,000 or another $6,000. So if we were to post that out, in other words, let's post this as we go, we're going to be writing up the inventory to what we believe the fair value is, the $65,000. Okay, and then I'm just going to do the same thing to the land here. I'm going to say, all right, the land is going to be worth this. I'm going to say we now think the fair value is higher, so it's the 163. It's on the books for the 86,000, so we're going to be increasing that 77,000. Then I'm going to assume that the building and the equipment are on the books at net, meaning cost minus accumulated depreciation here. So just to simplify the problem, so we're going to say, all right, the building, we're going to say then is going to be equal to the 517 minus the 406, and then we're going to say the equipment is going to be equal to the 576 minus the 517. So we're going to increase those amounts. Once we do so, then these amounts on the trial balance for S will line up to what we believe the fair value to be. So let's do that. I'm going to post these out just so we can see them as we go. So there's the 77. There's the building. And here is the equipment. So now we have over here the 65, adding up to the 65, the 163, the 517, and the 576. Now, the other side, the question, of course, being, well, where are we going to put the other side then? We just increase the value of these things. The other side, we're going to write to a gain. So we're going to say that kind of like a gain. We're going to write that to the equity section. So we're not going to be putting it to an income statement account. We're going to say basically what has happened is, a purchase took place, kind of like purchasing the entire company. So you could think of it as increasing, like a revenue account, you might think. But we're going to put it into the equity section here. It's not common stock. They didn't issue common stock. It's not additional paid in capital because that's related to the common stock. It's not going to be retained earnings, although you could think of it kind of like a retained, in a way. But we're going to make this new account. We're going to call it revaluation capital and just put that into the equity section. And it says exactly what it is. It says, hey, look, there's a purchase parent company situation here. We're revaluing the capital to basically a fair value at that point in time, reflecting the transaction that happened at that time, reflecting the fair value at the point in time of that, or the fair value adjustment. Okay, and then that's going to be the credit. So we'll increase the equity. I'm going to do the sum, the plug formula, negative sum of these items. And there we have it. And I'm going to put that here. And that's going to be the 253. So we've revalued the assets to what we believe they should be at the fair value point. So now that we know this difference, let's do our goodwill type of calculation to consider if there's any goodwill involved here. So we're going to say, all right, the book value of S, I'm going to say is going to be the equity section of S, or assets minus liabilities. So I'm going to say it's going to be the negative sum of these items, or you could say assets minus liabilities, right? And it's going to be the same here. So that's going to be the book value. Then I'm going to say, all right, then there's the difference between the book and the fair value of certain assets, which I'm going to say are these three. We figured out what the difference, or four. We figured out what the difference was. It's that 253. So I could say, all right, we could say, I'm going to say negative of that 253. And that would be the fair value of S. Therefore, the sum of these two then, you would think would be the fair value. That's what you think would be paid for. Now, in this case, it actually is what was paid, right? So I'm going to compare that to what the purchase price was, and we have the same amount there. So we have no goodwill involved. So no goodwill. We don't have to deal with populating goodwill here, because after we revalue to the fair value, that's the same. So we're not going to add the goodwill as we could do in the case if this price was higher than basically the fair value. So that's going to be our transaction here. So what we have done then is we have revalued the trial balance based on basically the fair value calculations at that point. All right, now let's imagine what would happen on the books of the parent company. What would happen to the parent company? And I'm going to make this basically a really, basic parent company, just having very little activity, so we could just kind of see the transaction here. So this is the equity method, and I'm just going to record this one transaction into this adjusting entry so that we can see it. So all they have is cash. We're going to say they're just like an investment company. They've got cash, and they've got retained earnings, right? What's going to be recorded on the parent company, the purchasing company books? Well, they're going to use the equity method, which just entails now the investment in S then increasing, and they paid cash, and the amount then was for the equals to, and we're going to scroll back to the right here. It's going to be that 942. So it's the 942. So there we have that. There's the debit and the credit. So then we're just going to say, all right, they're going to put this on the books at the 942, and the cash then will be decreasing the 942 here. So that's what we have for them. So, and then of course this 942 now, you could see after we make the adjustment over here, now the assets for S, the assets minus the liability, equals the 942, because there's no goodwill and we revalued the assets and the liability, or in other words, the equity now, of course, equals the 942, which has been put on the books for P. That, of course, makes the consolidation a lot easier now. So now let's think, okay, what if we had to consolidate these two entities now that we've done this this push down method, we're going to say now we fixed S to make the consolidation process easier. So if I was to take then the trial balance for P, which was just basic trial balance we had there with a couple numbers, and then we took S's trial balance over here, and we were to add them together just at this point in time, at the point in time that this all took place, then we could say, all right, then we would just sum these up, and boom, I'm just going to copy this down, copy, and then I'm holding down Shift and scrolling down. I'm going to Control V, paste that, so that looks good. And then we'll do our adjusting entries, which is simply going to be removing the investment account. It's going to remove the investment account here, and I should be able to do the full amount. I'm just going to say the consolidation will be for the full amount of the investment account. I'm going to put that on the credit side, negative of that. I'm just building this as we would go, right? And the other side should simply be equity of S over here. So then I should be able, and it should tie out, because this number here, if I was to take these items that we're going to remove, are the same due to the fact that we did the push down method. So I'm going to say, all right, then I'm going to take the common stock, just like we've seen in prior entries, and enter, and I'm going to just copy that and paste it down to retained earnings. And then I'm just going to be picking up these amounts, which is going to be the 106 common stock, negative of the 406 additional paid in capital. The revaluation is going to be removed here. And then the retained earnings for S. And then there it is. And if we just record that out, then we're just going to say, all right, then if I record that straightforward, we're just going to say the investment's going to go down, and the common stock is going to be removed for S here, as well as the additional paid in capital is going to be removed for S at the 406, and then we're going to have the revaluation removed. And then we have the retained earnings. So retained earnings, which will leave us with the retained earnings for P. And there we have it. So we don't have, notice what we're not doing here. We're not revaluating the assets at this point in time, because we already did so with when we did that to S's books. So that's the point. This transaction's a lot more easy, a lot easier than it would be if we had not done the push down type of method, if we had not, in other words, adjusted the financial statements for S. Now you could push this forward and we can say, okay, well, what happens, next year? Let's just push this forward 1 year. So I'm going to scroll all the way to the right and scroll down a bit. And let's pretend that this is S's trial balance for the next year. So another year has happened, and we're just going to say then now they've got income statement accounts down here, adding up to 103 of net income, and they gave dividends to, and obviously all the dividends went to P, the fully owned, because it's a fully owned subsidiary. Okay, so if this is S's books, what would P then be recording with regards to the equity method? So I'm going to go, okay, here's P's books, and all we're doing is taking the starting point, the 2005 numbers, and so we're taking these numbers from the prior trial balance here. And notice again, this 2000 X5 was kind of like that should be the beginning of the years, and there hasn't been any activity. So, but just bear with us here. It's just a holding account. We're going to say this is, now we've got the 558. That's going to be basically the beginning numbers down here. And then we're just going to record the equity method. So our focus here, of course, is on the equity method. So what would they do? They'd say, okay, well, they're going to record their portion of the income. So the investment then would go up. So we'd have to increase the investment. And that's for 100% because they own 100% of the income. So I'm going to say they have income down here of the 103. And then the credit then going to the income from S. So we're going to record income from S down below. And that's going to be the first journal entry, standard equity method transaction here. And notice we don't have to do anything funny. We just record all the income because we revalued S, and S should be recording any kind of differences or changes to things like depreciation correctly now after the point in time that they've been revalued. So then I'm going to say that the investment's going to go up by that 103, and then the income is going to be here. Then we know that S gave dividends so dividends to P, because P is wholly owned. So the dividends would be, this is standard equity increasing, we're going to say cash. And then the other side is going to be going and decreasing the investment. That's standard equity method stuff. And I'm going to say that this is going to be equal to the dividend that was given, which we broke out at that 59. So the dividend is then being given out. And then we would think that for P's books, using the equity method, we would then have the increase or debit to cash in S21 for that 59, and then the investment in S, I'm going to go into that, and that's going to be the credit. So now we have this 986 is the investment now. So now if we took these books together and combined them, let's imagine this is the end now of 2000X6, and this over here was the trial balance for 2000X6 for S and P. Combining them together, we're going to say, all right, let's do our little worksheet over here. Combine them together. So here's P, here's S. We're going to combine them together now and say sum of those two. We're going to say Control C, and then I'm holding down Shift to paste this down below. And so there we have that. All right, that should put us in balance here, and then we'll do our elimination entry. So the standard elimination should be fairly straightforward again, given the fact that we did the push down method, right? So let's take a look at what would happen. We're going to say, all right, the investment account's got to go off the books. So investment goes off the books, and that's going to be for the 986, and then I'm going to remove all of the equity accounts for S. So then I'm just going to go straight down the row here. I'm going to say this equals the common stock, and then maybe even just copy this and paste it down to the dividends. That looks good. And then I'm going to say this equals, let's do that one more time. This one, by the way, should be a credit. And then I'm going to reformat this. All right, now this is going to be negative of the common stock. This is going to be negative of the additional paid in capital. This is going to be negative of the revaluation, just removing all of equity in S as we've seen before, negative of the retained earnings. And then the dividends is going to be a credit to remove the dividends of that 59. So, and then we're going to have this income. So then we got to remove the equity portion down here, meaning the net income. So it ties out here to the 103. That matches what's here because we don't have to do anything funny again. We don't have to do anything to the depreciation or anything weird because S should be recording that properly based on basically like a fair value at the point in time since the purchase took place. So it's straightforward. Those things should tie out since we own 100% or P owns 100% of S. So then I'm going to say, all right, so then this is going to be equal to that income from S. And then we're going to debit that amount. So we'll debit the 103 for that. And that should be it. So does that tie out if I highlight this whole thing? Adds up to 0, right? That's our elimination entry. So no, we didn't have to revalue anything and whatnot. So it's still a long entry, but still it's a lot easier than if we didn't do the push down method. So then if we post this out, then of course, I'm going to say this should go down to 0. So that goes down to 0. Then the common stock, and I know I'm doing this a little faster because we've seen these a few times. So I'm going to say then the 106 is going to go down to 0. And then the additional paid in capital is going to go down to 0. And then the revaluation is going to go down to 0. And then the retained earnings, we will remove S's portion, the 177, leaving us with P's portion. Then we're going to go to the dividends, and we're removing the dividends for S, which is all of them right now. And then we have the income account that's going to be removed as well, and that should put us in balance and take the income account from S, the income from S, down to 0. So bottom line, we're back in balance, and we've now achieved the goal of basically making this account 0 for the consolidation, removing the equity section for the subsidiary, leaving only the parent equity section, and then down below removing the income from S. And again, even though that journal entry looks long, it, as you've seen if you work some of the prior problems, is a lot easier than us having to revalue all those accounts that were affected when we did the revaluation, as well as the possible income statement accounts that could have been affected during that process as well.